The main focus in financial markets at the moment is on Europe and specifically on Ireland. You may recall back earlier in the year the focus was on the governments of some of the fiscally challenged economies, including Ireland, and governments took pretty major steps to rein in their huge budget deficits and pull back some of the expenditure that had been taking place since the start of the global financial crisis so that they could remain solvent effectively. Now that had all started to take place, Greece was also on the spotlight back then, but now the focus is on the Irish banking sector. It needs recapitalisation, and the task is too big for the Irish government alone. They're having to go to the European Union and IMF fund for assistance. So this has been the main focus, and the fear is that the problems that the Irish are facing are going to also be faced in Portugal and Spain. If fear grips the market, these economies may well need to tap into that fund as well for assistance for their banking sectors. So that's been the main focus, and it's certainly stressing out financial markets a bit at the moment. But yesterday we got a credit rating downgrade to our outlook from Standard & Poor's. Now this isn't the same as a full credit rating downgrade, it's just a change to the outlook from stable to negative, but it's a big red warning flag for global investors. And that saw the New Zealand dollar get dumped by about a cent yesterday against the US dollar, and it saw the yields on our long-term bonds rise somewhat. Now for exporters, the New Zealand dollar dropping might sound like quite an attractive deal, but it's not as simple as all that. If we were to get a credit rating downgrade, it would end up flowing through to our interest rate costs, and our interest rates would probably rise quite a bit on the back of that sort of ratings change. That hasn't happened yet, it's just a change to the outlook. With all that negative news, it was no surprise that it was a night where investors were wanting to take a bit of risk off. We saw share markets weak around the world, and the Aussie and New Zealand dollars are down. New Zealand dollars buying around 77 cents US. Aussie dollars dipped back from the parity figure against the US dollar as well. And on that cross rate, New Zealand dollars trading around 78 cents. In terms of local data, yesterday we had tourism and migration figures. Annual migration continues to ease, and that's largely on the back of a pickup in people travelling to Australia on a permanent or long-term basis. That's about it for the data released today, apart from the RBNZ survey of expectations which come out today. Now the main thing we focus here is on 2-year ahead inflation expectations. We want to see how well anchored those expectations are, and inflation expectations for 2 years ahead is tracking around 2.6% at the moment, so it's reasonably high. In terms of offshore data, there's quite a bit out. There's a reading on US GDP or economic growth for the third quarter, and there's also some US housing figures out tonight. But the main focus is going to remain on developments in Europe.